capital markets. I think the question we're all asking ourselves is there adequate financial models and financial instruments to meet this ambitious plan of clean energy, sustainability, and meeting the climate goals? So I'd like to introduce our three panelists. So our three panelists here today are Karen Bajachu, CEO of Arcadia, Jamie Martin, Executive Director, Global Sustainability Finance Group at Morgan Stanley, and John McKenna, CEO of Hamilton Clark. What I'm going to do is give them 2 to 3 minutes to introduce themselves and talk about what they're working on before we talk about our detailed topics at our panel. So why don't we start it off with Kieran?
Great, thanks, Marty. It's great to be here with everyone. I'm the CEO and founder of a company called Arcadia. We're based here in DC. We were hoping to open a small satellite in New York in March of last year, and thank God we didn't sign that lease. But we are about 150 people, mostly technologists, product design, engineering. Our model is pretty unique. We're building what we call the first digital utility. We built a technology platform that actually ingests a bunch of data from a customer's utility account, and we built a marketplace to help connect people to 100% clean energy. One of the many products on our platform, and one we're most excited about, is community solar. It's this idea of someone building a large-scale distributed generation asset, like the one behind me here, that's in Western Mass, anywhere from 2 to 10 megawatts. And we bring customers to actually buy the power from the project at a rate lower than the utility rate. So, I mean, hands down, I'm biased, but it is the greatest clean energy product on the market today. The way we structure it, and I think part of this panel topic, is with no credit check, no long-term contract, no cancellation fees. And that scares the hell out of a lot of bankers. And we spent a lot of time working on how to get over those humps, which I can talk about in more depth later. But we have financed close to 0.5 gigawatt of community solar in terms of, I should say finance. We brought offtake, but we've helped the finance community get comfortable with that model. And that's the majority of what we work on. And in the future, we're looking to do a lot around financing DERs in the home. So EV chargers, thermostats, et cetera. So excited to be here and talk more about data and how that can help underwrite some of these new energy products.
Thank you, Karen. I'm going to pass it over now, talk about what he's doing at Morgan Stanley.
Great. Thanks, Marty, and good afternoon, everyone. I'm based just north of New York, and it's great not to be able to join these types of events so seamlessly in the virtual environment. So thanks again for having me. As mentioned, I sit in the Global Sustainable Finance Group at Morgan Stanley. We, in kind of the essence, take what Morgan Stanley is really well known for, and across the capital markets, within our investment banking and capital markets businesses, across our global asset management business, and then across our Morgan Stanley wealth management business, take what we're really good at and try to think very strategically about how we can add kind of a sustainability and ESG and impact lens to that. As you all are well aware, this is a conversation that has evolved dramatically in the past, I'd say kind of 24 months. I think our team was actually founded in 2009. I joined the team in 2013. So this is a trend in the space that we've been touching from lots of different angles as a global financial services firm, really advising our clients, whether they're big corporations or governments, as Marty mentioned, that now have net zero commitments and have kind of woken up to the fact that they're being evaluated by investors on not only their financial performance, but also their environmental, social, and governance, and how they treat, not just their shareholders, but all of their stakeholders, whether it's their customers, their employees, their community members, et cetera. And I think what is happening now, and we'll get into this, is that the capital markets are using the tools in the tool belt around finance, both on the equity side and the debt side, to really try to catalyze the investment capital that's needed to scale some of the solutions that Kieran and Arcadia sound like they're working on around distributed solar, across a whole host of circular economy related activities, and a whole host of clean energy as well. And clearly, from the policy side, Europe is really kind of leading the way on how policy can set the agenda for a more sustainable, just economy, and I think this is going to start happening here in the U.S. pretty quickly as well. And then finally, and we can touch on this as well, I work very closely with colleagues like Lila Peck, who I know is on the line within our wealth management business, really to help individuals and families and our wealth management clients kind of navigate, the most appropriate ESG and impact investing solutions that are available in the marketplace. And this, again, can devolve quickly into a whole host of different acronyms and get complex quickly, but we really try to make what we call sustainable investing as the umbrella term as accessible and actionable as possible. And so I can explain a little bit how we help our clients navigate all that within their wealth management relationships as well.
Thanks, Jamie. All right, pass it over to you, John, for intro.
Great. Thanks. So I'm John McKenna, and I am the CEO of Hamilton Clark. Actually, the firm is Hamilton Clark Sustainable Capital. We changed the name of the firm about 10 years ago. The firm was originally organized in Houston in 1990, so we're going on 30 years of trying to help companies really in the energy technologies. And then pretty much 10 years ago, we focused exclusively on decarbonization, climate change solutions, sustainability. The firm currently has 15 members, 14 managing directors in 8 cities. We actually just brought a fellow in Zurich to try to reach out to ESG investors in Europe. Generally, what we do is we work with clients to either help them raise capital at the corporate level or at the project level. And so for clean tech and sustainability, that's really assisting the technology to get mature and then to deploy that technology in projects. So half of our business is financing. The other half is merger and acquisition work, where we've really specialized in our sectors, ag tech, food tech, transportation, and the whole wide range of renewable energy technologies. I would say these days, so many of our referrals are coming from people who are investors and board members of companies, really who are trying to help them expand the business through financing, or if it's time to exit the business, to sell it. So we're really, everybody in the firm is very excited about the sector, and really glad, Marty and Dave, that you've asked us to participate.
Yeah, thanks, John. Really appreciate all of your time here today. I'm going to start out with just a very question for Kieran. Just talk about his success raising capital, and talk about the sort of the financial models that you've been using for project finance. If you can talk about your success or maybe challenges that you've been running into with securing project finance. You're on mute.
Kieran, you're on mute. You're going to have to redrop those pearls of wisdom. There you go.
Yeah, you guys missed the most important thing. So I was going to say we were not that successful in the early days. So we decided, traditionally in community solar, this was a nascent market even when we started the company. It's really exploded. But there were companies that were doing 20-year high cancellation, 750 FICO. It looked like rooftop solar. But the nature of the product is so different. You can live in an apartment, you can move, you can sleep in and out. it's not rooftop solar. And so we had to really spend a lot of time with banks, with tax equity, to help them understand that fundamentally the product was different. It's cheaper than the utility guaranteed, but also that we brought a lot of data to the table that they'd never seen before. So when a customer signs up for us, we can show, did they pay their power bill on time? And how does that work as a proxy for a FICO or a credit score? And frankly, why it might be better than a FICO or a credit score. And we've now amassed, years of data on that to be able to show people, hey, this is actually, there's a lot of friction there, and limiting the product to really, rich, wealthy, good credit score customers, that we should be expanding that. So that was a huge one. I mean, just being able to bring data to the table. So, and I would say for us at least, so there was a lot of difficulty in the early days. We knew we wanted to bring this simpler, easier, frictionless product to the market. And then there's sort of a lemmings and a type thing that happens with a lot of the finance community, where if they get comfortable with one type of structure, they see other folks doing it, they want to quickly jump. So I think there's just that initial barrier. I tell other companies that are looking to finance maybe their early projects, that it's okay to take a significant haircut, I think, to get your first few projects financed, get data, prove the returns that you claim you can bring and that the reliability is there. Because at the end of the day, most project finance is all about reliability of the cash flows, and can you actually provide that return that people are looking for? And then each subsequent sort of portfolio of projects that we've been able to provide customers for, we've been getting better and better terms. And it's become easier and easier to unlock tax equity. So I think getting that proof of concept in market is just huge. And the difficulty is oftentimes even getting folks to back that. Like, for example, one of our first community solar projects, we actually had to just get a high net worth individual to finance the solar asset. And that's obviously not scalable and not great, but we did it. We got the data, and then we took that to the next bank. So that was part of what worked for us, and it was really helpful in the early days.
I appreciate that. Let me pass it over to Jamie here. I'd like him to sort of touch upon the financial products and models that you guys are been seeing in the market. And I know you guys have been developing your own new models the last couple of years. So if you can talk about that.
Yeah, I mean, I think, again, from kind of the Morgan Stanley capital markets perspective, our team has been very involved in kind of growing our green bond franchise. Green bonds, kind of started in the realm of some of the supranational or, the World Banks, the IFCs of the world, and quickly have become adopted by a whole host of issuers, whether they're, companies, municipalities, public companies, private companies of all different stages across the entire, I'd say, kind of credit spectrum. We're seeing, high yield green bonds starting to be issued. And yeah, I mean, the green bonds by themselves, right, are pretty, plain vanilla fixed income instruments, with the innovation being that, inside the green bond, you have basically set up kind of a ring fence around the use of proceeds and, committing to using the money that you're borrowing from your investors to solely use for, environmentally friendly or sustainability projects. And then you essentially get a second party opinion to verify that the money that's being is actually that you're borrowing is actually ending up where you're saying it is, and that those projects do result in kind of significant carbon reductions. I think the green bond market also, I think rightly so, has also been, gotten some skepticism, right, around, is this, kind of just greenwashing? Is this, companies just borrowing money that they would have been borrowing no matter what? But has, I think, really catalyzed some pretty interesting activity. I think the overall issuance of the green bond in 2020 market globally exceeded, I think, $350 billion, which is, still just such a small drop in the bucket of the overall fixed income market, but it's still got some very interesting, hockey stick type growth. And now what you're seeing is the big institutional money managers, the BlackRocks and State Streets and PIMCOs of the world, have enormous demand for this type of product, right? So these bonds, when they come, they're always oversubscribed. And as a result of, I think, what is kind of a supply and demand mismatch, you're actually starting to see a bit of a greenium, right? So these bonds are actually starting to price a few basis points, tighter compared to where the bond of the company would be if it was just a regular way traditional bond. And so that is going to potentially incentivize even more issuance if ultimately issuers can borrow at a slightly cheaper rate. And we'll see how that all kind of plays out. The other dynamic that's starting to emerge is a new innovation where it's essentially what's called a sustainability linked bond, or where you're actually, the issuer is going to issue for general corporate purposes. They can kind of do what they want with the money, but they're going to embed a KPI, a key performance indicator, in the bond that is going to result in, around a sustainability target. So if they have a commitment to reduce their energy consumption by 45% in the next 10 years or the life of the bond, they'll make that commitment. And if for some reason they don't hit that hurdle, there'll be a step up in the yield of the bond, right? So their debt would get more expensive if they don't hit that sustainability target, which I think is an interesting way for companies to really signal how seriously they're taking this if they start to link how they're financing their company with their own internal sustainability targets. So we saw that with an Italian company, Enel, last year, an Italian utility, and I think it's starting to resonate more broadly across a few sectors as well. And this notion of a transition to a less carbon economy, right? So if you can start to embed some of those KPIs as some of the very carbon intensive industries, whether it's steel or shipping, agriculture, et cetera, this could be a mechanism to really accelerate that transition and have investors compensated kind of appropriately. Now, some would say there's a perverse incentive there, right? Where if you're a green investor, it's got to be, let me get this straight, I'm going to get rewarded if the company doesn't actually hit their sustainability targets. That's perhaps not the best dynamic, but I do think at the same time, again, just an example of trying to use kind of the financial mechanisms to get more attention, and really kind of the scale that these green bonds bring is important as well. I mean, these are, typical benchmark large, $1 billion plus transactions from the investment grade companies. But at the same time, we've also done, very bespoke, smaller offerings for companies. One that comes to mind is what we did for a company called Fulcrum Bioenergy that has a reactor where they're turning municipal waste coming out of our homes into jet fuel. Right. And so again, that's an example of they were able to get a tax exempt financing green bond as they're clearly using kind of a sustainability focus with their business model as well. And then the other thing too, I think just to touch, it's important. ESG sometimes
I'm gonna have to
lost. Go ahead.
Sorry, I got to cut you off. Okay. We're running out of time.
All right,
but it's great because the folks joining you in the smaller discussion can ask you some more questions on this. Hey, John, can you talk to us about the structures you're working on with your clients?
Sure. Thanks, Marty. Yeah. So really what we're seeing from our clients is normally, we could hire, we're an investment bank. And so we get hired by the company to try to figure out, firstly, what is the best course of action for the company? Is it to raise additional capital at the corporate level, build either the first project? And I was very excited to hear some of the comments on the algae project from Nathaniel. Know exactly where he's standing there. We've done a lot of work in algae. The question very succinctly is, do we raise money at the corporate level, deploy it into the business, into the project, or do we try to raise money at a project level and therefore sort of shield the corporation? And you all know the nuance of project financing. So what we've seen, and again, we've been doing this now for 30 years. So what we see is really an ability to work with companies to try to push the project side, the project debt side, and in essence to try to solve and mitigate the key risks that you see in project finance, even for early stage projects. If in fact we determine and help companies figure out that that's almost impossible, then we'll help them raise money at the corporate level. But there are a lot of really innovative ways to mitigate some of the project risks that would be normally seen in a project financing. Feedstock risk, offtake risk, technology risk, execution risk. And the exciting part of the project finance world right now is putting together projects for earlier stage companies, earlier stage technologies that weren't really geared for project financing. And as you all know, project financing really started in the mining and petroleum side, where there was really zero risk on technology. And if you had an offtake agreement, you could get it financed. That then led on to PPAs in the electricity side. But really what our firm is doing is working with companies to push the envelope on trying to get private debt funds to accept these risks. And I know you want to turn this over, Marty. So
we have 1 minute here. So what's the big takeaway here in terms of the next year or two that you think maybe models are going to slightly change based on what you're working on?
Well, from our perspective, yeah, they'll change because private debt funds that have been raised to, in essence, do a high yield financing are willing to take more risks in the project side. The yields are very high. They get a senior secured position in the project or the company, but they're really willing to be a lot more flexible. And that's, I think, the takeaway is the private debt funds are really impacting this sector. And that's what we do. We work with companies to marry them with the best funds out there.
Excellent, excellent. I think we're out of time, right, Dave?